Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen along with our co-host Anthony Faso. And today what we're going to be talking about is why definitions and meanings of words are important. Often what you find in this industry is you find that words get changed or used interchangeably, and that can create a lot of confusion. And so when Anthony and I are talking to clients, especially on the front end, this is one of the first things that we address. And so we've wanted to create this podcast for a while now. So I'm excited to get started.
Yeah, I think this is an important podcast because I think what we're going to talk about are concepts and words that are commonly misunderstood. Like, for example, if your financial advisor called you and say, "Hey, Cameron, let's move all your money and let's start speculating with it."
Ooh, I don't like that. Yeah.
But that's what they're doing. And so what we need to know is we need to know the definition of those words and in what you are doing. Words are very important. And I think you're seeing that a lot now in this cancel society. Like, you say one little thing wrong, you're going to upset some people. Right? Words are very important. Just like you've heard, like, people who are very successful, if you notice, it's not so much the tools or the products or their education that they had. It is the mindset of them focusing on certain things and just being laser focused. And part of that is classifying what you're doing and using the proper words that can help you focus. And as you know, words are very important, and a lot of times people will use words of affirmation. Like one of your idols, Stuart Smalley, right, from SNL. You're, smart enough? You know it. Go ahead. I know you know it.
I don't know what you're talking about.
You're good enough, and gosh darn it, people like you, right? Now, that was done in jest, but peeling it back, of having those words words are very important.
Words are very important, especially the definitions of them. And so today what we're going to be talking about is we're going to be really talking about three different words. Number one, the first one is savings. We're going to talk about investing, and then we're going to talk about speculating. So we're going to go through each one of these and kind of come up with our working definition of them, and then we're going to give an example, and let's go from there. Let's get started. What do you think?
Let's do it.
Awesome. One thing that I will say before we get started is I wanted to bring this idea up of connotations, right? The reason that, this is my personal belief, is the reason that a lot of these words get used interchangeably in our industry is because certain words have a connotation that come along with it. And for those of you that are listening in for Anthony, connotation means it's the kind of feelings that are surround a word, not only its actual definition, but the feelings that come along with that. So what Anthony had mentioned a minute ago is there's sort of a connotation that surrounds the word speculating, right? Would you agree with that?
Yeah.
Yeah. And there's a difference between speculating or savings. And so what you'll see a lot of times with a lot of big name companies in our industry, financial institutions, is they don't use the appropriate word because that word has some certain feelings that come along with it. Connotations?
Connotations.
All right, Anthony, so let's get started. Let's dive in here and let's start thinking of the word savings. Now, you and I talked in preparation for this podcast. We came up with a working definition of savings, but what was weird about this word is that it actually kind of had two different definitions. Would you agree?
Yeah.
Yeah? Do you want to take the first one?
Yeah, we kind of compare, like, saving is a noun, but it's also a verb, right? So let's start with the verb first.
I'll dive in. This is usually what I refer to when I'm talking to clients, is because for me this makes the most sense. Is when I bring up the idea of savings, is for me savings is an action word. It's a verb, right? It's the act of moving money from one account to the next. And for me, is I want people to understand that, hey, this is literally what we're doing. We're moving money from one pocket over to the next at the most basic level, right? Mm-hmm. And how about as a noun? You want to take that one?
Yeah, as a noun, what we have as our definition, let's say it's commonly referred to as a nest egg or capital or one's reserve, money that you have saved or stored up. And the expectations that we should have with savings is that it's safe, it's protected, it's liquid, And here's one thing most people don't keep in mind is that this needs to outpace inflation.
Mm.
How many times have you had people have money in savings, right? And it's sitting in a bank account or savings account or nothing, and it's barely earning any interest.
Mm-hmm.
And the problem is if that interest is not equal to or more than the rate of inflation, you're actually losing buying power. And we like to say that your money's actually rotting. You may have $100,000 in savings, but after a year, that $100,000 can't buy what it could a year ago. So we need your savings account to be able to at least keep up with inflation.
Totally agree. I've had clients over the years that have had that saving has been an obstacle for them, right? Where, hey, you know what? There's just not a lot there sometimes, right? And it's not because they don't have a good income. It's just the habit just hasn't been built in or created yet. And so one of the best books that I have been able to recommend over the years is a book by George Clason. It's called The Richest Man in Babylon. And if you have not read this book, take the time to read it, because this will provide the importance or shed a light on how important savings is. And I will kind of summarize this book. I'll paraphrase it if I can for you. There's a lot of really good lessons, so if you haven't read it, read it. But what I will tell somebody is that here's the takeaway that I had in regards to savings from this book is this is what most people will do. Most people will go out, they'll earn an income, they'll go pay their mortgage, they'll pay their credit cards, right? They'll pay the car payment, they'll pay the house cleaner, they'll pay everybody else, and then what they do at the end of the month is they're going to save what's ever left. After you've read this book, is the importance of the lesson is, listen, you are putting yourself in the very last position in this scenario. And after reading the book, you'd better understand that you'd better put yourself in that first position. And the way that you do that is, what you do is you earn your income, and then you choose how much you want to save first, whether that's 10 or 20% of your income. And that's the first thing you do at the end of the month is you save, and then you pay your mortgage, and then you pay your car payment, and then you go pay the housekeeper and everybody else. And listen, at the end of the month, if there's not enough money, it's the housekeeper or somebody else that doesn't get paid. It doesn't reflect on your savings. So if you haven't read that, go read it.
Yeah, and Robert Kiyosaki also does it, I think, in Cash Flow Quadrant or Rich Dad, Poor Dad. He actually says that he pays the IRS last. Right? For one, they're not as squeaky as the housekeeper or your car payment. But what he's realized that, again, he pays himself first, and then he pays for his other things. And just like Cameron had mentioned, and Robert talks about it, that at the end of the month, if he doesn't have enough money to pay the taxes, either he'll stop spending or he puts that pressure on himself to really be more diligent with saving more or getting more out of an investment. And it's kind of like what Nelson talks about in his book, Becoming Your Own Banker, Parkinsons Law, right? And Parkinson's Law is probably one of my favorite rules that he has in the book, and it's one that I probably suffer from the most. And Parkinson's Law says that there's a few different ways to say it, but in essence, it says that expenses will rise to your income. Right? How many times have you gotten a raise and you're like, oh man, I'm making an extra 10 grand a year. Oh, I'm going to save that money, right? Because you're used to living on 10 grand less, but you get that money and like, oh, well, you know what? Maybe I'm going to go out to dinner more or vacation more or buy a different car. But you can beat that by paying yourself first.
Great point.
Cameron, as we're wrapping up savings, we define savings as money that's safe, protected, liquid, and will outpace inflation. Where do you think is a good place to store your money to meet that requirement?
Well, we have looked all over. We've looked at almost every account that you could possibly imagine, and the best place to store liquid cash is inside a properly structured whole life insurance policy.
I totally agree. So, but we need to keep that in mind. When we're looking at a policy, remember that this is a savings vehicle.
Mm-hmm.
So we shouldn't compare a savings vehicle to an investment or a speculative investment.
Mm-hmm.
That's why it's important to categorize these. And so we want to compare savings vehicles against other savings vehicles. And hands down, a properly structured infinite banking policy would be the best place to store your savings.
Great point. Is what just came to me was that's the thing, right? That's the place to put it. And again, what I had mentioned before was the definition on the verb is the action. One of the best things that I have seen over the years that comes along with using infinite banking and using insurance policy is almost the act of forced savings, if you will, on a monthly basis, right? The definition that we used was savings is an action, it's a verb. And really what my policy has been over the years is a forced savings account, right? Is every month as I'm sending dollars to that account that is building up cash value for me. So I want to make that connection between the two definitions. Noun is the thing, which should be the account. And then the savings definition, the action part of it, is the actual monthly or annual contributions to it.
So, Cameron, do you have a recommendation on how much people should be saving?
Yeah, 20% or more, right? I mean, I think every financial advisor in the country, right, is would agree with those numbers. I don't think 10% is enough. I think 20% if you can do it. We've got clients that are saving more than that. So, and then we got some clients that are saving less, but you got to get started, right? So
yeah, the important thing is to get started. 20% can be a high number if you're starting out from zero, but you need to do something. Like that's something we can't help people develop the savings habit, right?
Yeah.
But once we, like the rule of thumb I have is let's shoot for 10%, right? And then if we have some bad debt, which would be credit cards, or basically bad debt to me is debt that you're paying, right? Outside your mortgage. But if you have an asset or like a mortgage on a rental property, your tenant's paying that. So to me, that is good debt. But if you have some bad debt, let's take 10% to start, first 10% saving, and then 10% of plowing this bad debt. And then once we have that bad debt off our backs, then we can add that other 10 to our savings. But really, I think the savings isn't sexy, right? Or maybe you think it is, Cam. But a lot of people just want to jump to investing and speculating. But I think if anything, the times we're in right now, like right now we're in August of 2020, there's a lot of unknowns. There's some uncertainties out there. So that's when we need to have the savings. We need to build up that savings first. Once we do that, that creates an environment that it gives us permission to invest.
Well said.
And that's even a good segue. Where are you going to go?
You said that savings wasn't sexy, so my segue was going to be, let's talk about something sexy. Let's talk about investing.
Okay, let's do it.
Here's our working definition that we have with investing. It is parting with your money with the expectation that your principal will be safe and you'll receive an adequate rate of return in the form of cash flow via interest, dividends, and or profits. Anthony, what do you got to add there?
Well, I would say one thing that as we were defining this, I think where a lot of people, this is going to be a little different when they think of investing. Because I think a lot of times people are confuse investing and speculating. But with this investing, what I heard you say is that you expect that principal to be safe.
Yep.
Right?
Yep.
Which, if we are investing, it's not going to be as safe as your savings. But we should also be expecting some cash flow, right? What I didn't hear you say is, well, I'm going to buy this and then I'm going to hope that it's going to appreciate. You didn't mention the value of the underlying asset. It was just the income that asset is going to produce.
Totally agree. Yep.
And especially right now when we're, one of the number one investments we like are cash flowing real estate. Notice I didn't say real estate in general, but we want real estate that is cash flowing. And if you have it cash flowing, the appreciation is a bonus, right? We're not relying on the appreciation. When I remember in '07, I had plenty of tax clients that were buying real estate, and they were actually losing money each month, which is the exact opposite of cash flowing. They were putting in a couple $100 a month, but you know what? It was appreciating a couple thousand a month. So on paper, that sounded like a pretty good deal, right? Until it wasn't. And then when the housing crisis happened, you lost that tenant. But again, they were focused on the appreciation. That's why they bought it. That appreciation was not there. So a lot of times it didn't make sense, or they couldn't afford to keep the property. But right now, if you buy a property and it's cash flowing, that's the important piece. The appreciation or the value of that asset, it doesn't matter until you sell it. But typically, we're holding these assets for a while. So it's going to go up and going to go down. And that's okay because you're not selling it. And each month when that tenant is paying your mortgage, you're building a little bit of equity.
Well said. The notes that I've got here, right, the way that I think about investing is low risk, high control, and we have a predictable outcome, right? So the conversation that we'll usually have is around the predictable outcome. Is people will say, hey, isn't real estate investing? Yes and no, right? Is when we are analyzing potential turnkey rental properties that Anthony was referencing, is we're not buying just any property that shows up, right? Is there's a certain criteria that you take that property through to analyze whether you're going to invest in that or not. And that is a very important piece. And so that is an example for real estate, right? Another example would be somebody's business, right? Is I've told this one over the years that I had a plumber that came in and essentially he said, hey, what's the best stock tip that you could give me, right? And I said, okay, well, why? As that idea right there is, right, that's a means to an end. What do you really want? Well, I want to make more money. Okay, well, how do you make money? What do you know most about? Well, I know most about my business, this and that. Okay, well, great. How much, so the expectation of the conversation that I had was, what would be your expectation if I gave you the hottest stock tip right now over the next year? What would you make? Well, I don't know, 15, 20%. Okay, great. What do you know the most about? Well, I know most about my business. Okay, well, what if you took that same 50 grand and went and bought 2 more trucks and hired 4 more guys to go work those trucks for you? How much money do you think that would pay off? Well, probably a couple $100,000. Okay, well, what are you doing here, right? Right, exactly, right? So the best investment, this is what I tell everybody, the best investment is going to have 2 trademarks. One is we got to have control over it. Number 2 is we got to have an understanding of how this thing works. What we see a lot of times is people making quote-unquote blind investments or investing into something they don't understand, and those will never work out for you.
Well said, Cameron.
Yeah, well,
wow,
thank you.
I'm impressed.
Wow. Episode 51, he's impressed. All right, so let's move on. So we talked about investing, right? And we talked about those. We gave a couple of examples. How about speculating? This one, I think, is going to surprise kind of a lot of people. You want to read off our working definition of speculation?
Buying an asset with the expectation of appreciation, meaning that the value will be more in the future.
Absolutely. What we've got here is we have the expectation. Oh, I'm sorry, I was looking at the wrong. Expectation is buying for resale rather than for use. The probability of a loss is going to be high. This is where we're going to have the highest amount of risk and the lowest amount of control. And this is what I've seen. I don't speak for you, but right, this is what we see all the time. Is we'll have clients that will come in, right, and what they've been doing over the years is they've been contributing to accounts that have no cash flow, no collateral, and no control. And when we start to work through these definitions, is they actually realize, oh man, I'm not saving or investing. What I'm really doing is I'm speculating. And that is one of the biggest realizations that clients will come to, and will say, well, what do you want to be doing? Well, I want to be saving and I want to be investing. Okay. So really what I feel like I've done over the years is I have allowed people to stop speculating by educating them on what that is, and allowed them to start saving first and foremost, and then coach them along to invest in things that they know about.
Well said, Cameron. I said that's twice in one episode.
Wow.
I know.
It.
Wow. I'm even amazed.
Killing it.
So we've talked about savings, investing, and speculating. Now, Cameron, with most of your clients, do they need to be speculating to achieve their goals?
No. Most clients don't even need to get to that speculation point. And here's what I mean. I'm going to give you kind of a big, broad overview. I don't know if this is what you were looking for or not, but here's kind of the steps that people make is number one is you got to start saving, right? It's like you talked about is, hey, we need to start saving something. If you're not saving now, start saving 5% or 2%, whatever it is. We want to get that as high as we possibly can. Once you build that pool of reserves, that capital, now what we're going to do is we're going to go make investments into something that we control and that we understand, right? Something that there's an adequate expectation of an adequate return. And then once you start to do that, you find success is you're just going to go do that over and over again, right? And if you do it correctly, you're going to attain financial independence, hopefully, right? That's the goal. Mm-hmm. The problem, right, that I see with where speculation is all the way down there on the far end, right? It kind of sits out there with gambling. Mm-hmm. And most of our clients, if you take them through savings and investing, they never even have to get to the point of speculating to really create wealth in their life, right? I'm gonna get you're gonna get me going now, right? Yeah, because this is the difference when we talk to clients. When I talk to clients, is there's a big difference between what quote unquote wealthy people do versus what kind of the average person does. I'm putting myself in that group as far as average goes. Is man, people come in, they say, hey, I want to invest, like pick a guy, Warren Buffett. Mm-hmm. Right? Warren Buffett is not investing like you and I or the average person is investing.
How so?
Warren Buffett is investing Berkshire Hathaway's money. He's worth $50 billion. He's already gone past the whole process of putting savings and investing in place and financial independence. He's way out here on that kind of speculation of spectrum, right? Where he's not investing for a 20 or 15 or 30-year time horizon. He's investing for a 50 or 60-year time horizon, where individuals have a time horizon that is dictated by retirement age, right? So it could be 10 years, could be 15, could be 20, and then the individual has to take that income or that those assets and turn it into income. I don't know if that's what you're looking for, but
no. I'm not going to say well said, but if you look at how many people do you know, Cameron, that's made $1 million in their 401k?
None.
How many people do you know that have made $1 million through investing, whether in their business or real estate?
Many.
And so that's where, if your goal, hopefully it's not to be a millionaire, because if you've been listening to us, we don't want to talk about net worth. What we want is cash flow. Right? Just like what Robert Kiyosaki says, our goal is the passive income is more than your expenses. You can't do that speculating. We need to create some passive income, whether it's real estate, a business, or some other thing that you are knowledgeable about.
Here's the thought I just had, is the way that I would say this is that the market is where people go with their money after they've created it. Right? So the way to create wealth, right, is through a business, developing a skill set, or you almost always see real estate included in someone's portfolio if they've created substantial amounts of wealth over a single lifetime because of the ability to leverage, right? So real estate has got to be in there. But the thought, the train of thought that I was going with is that wealthy people, they're playing a different game. That's not the same game that we're playing. And so what people don't realize is that when you're trying to follow somebody that's quote unquote in the market, is they've already gone through steps 1, 2, and 3, right? If you're having already accomplished those, is man, don't try to do what they're doing. Is you got to take the baby steps. You got to go through it. And so for us in our hierarchy of wealth conversation is tier 4, right? That's pure speculation. What we're going to do is we're going to start at tier 1, which is kind of cash value, work up to tier 2, which is control, you and your business, and then tier 3, which is kind of real estate and or lending. So,
right. And so as hopefully you can see the difference in the words between investing, savings, and speculating. And what is it that you want to do? Based on these definitions, are you doing what you want to do? You know, and if you want to make a change, what I'd recommend is you can get on a discovery call with Camerai. We're kind of walk you through to make sure you have a sound savings plan, that you have some opportunities for investing, that you're not just speculating.
Awesome. Well said.
Well, thank you. Also, we also have an ebook on our website called Financial Planning Has Failed, which this would be a good opportunity to talk about some of the major flaws with typical financial planning.
Yeah, totally agree. If you guys haven't read that, make sure you get it. Some really good information there. We touched on some of the topics that are in that book, but if you guys have an interest, make sure you get it.
Awesome. I hope you enjoyed the episode and make it a fantastic day.
Take care.